Uninterrupted Investment Show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I'm Brent Wilsey. Just about 8:02 on Saturday morning. Great to have you here this morning and every Saturday morning talking about your investments, the economy, and all these important things to make your wealth grow. And with me is Chase Wilsey. Good morning, Chase. How you doing?
Good morning. Doing well.
Always, and this is why I've been doing this for over 40 years. It's always new. It's never like, oh, it's a boring week. Always got something going on, something strange. We got some big news coming up next week. We got the debt ceiling raised, or maybe not being raised. That could be a problem. We've got employment numbers coming out next week. Past week, we got some things to talk about. But I mean, that's why people say, when are you going to retire? It's like, why would I retire? There's so much going on. How could I retire?
Yeah, I know it's dynamic for sure.
Yep. So let's talk about this past week here. Talk about something that was kind of, I'll say surprising to me, but not surprising. That's Scarlett Johansson. Johansson is suing Disney after the recent release of Black Widow. Now, she's claiming that the release of the film on Disney Plus, which generated at least $60 million in premiere access rental revenue over the first weekend, had an effect on the box office, which had ticket sales of $80 million in North America and $78 million in international theaters over the same time frame. The problem here is Johansson claims a large part of her salary relied on the ticket sales for the movie. Well, of course that's the case. That's what it's been for years, and all of a sudden they're trying to sneak in the streaming.
$60 million's a lot, and to not have any bonuses tied to the streaming portion, definitely kind of a bait and switch, I would say. And Disney's response to the lawsuit, it was pretty surprising to me. They said there's no merit whatsoever to this filing. I understand that portion of it. I think most companies are going to deny,
right,
which is fine. But then I think they just really overstepped themselves and said the lawsuit is especially sad and distressing in its callous disregard for the horrific and prolonged global effects of the COVID-19 pandemic. I just think that to bring that up and into the fight here, I just think that's wrong.
But wait a minute. Wasn't Disney making money?
And I don't know. I'm just going to say, based on what I've seen so far, I'd have to say I'm on Scarlett Johansson's side, as it does appear Disney is using its new platform and the pandemic to really kind of circumvent paying the actress. And at the very least, I believe this lawsuit will create major changes to contracts for actors and actresses, as they now need to take the streaming into consideration when looking at compensation. As you said, it's been based off the box office for years. Well, now if you're generating $60 million on the streaming side of it, it's like, well, I want my compensation to be tied to that as well.
Right. And one thing I was trying to analyze this and thinking about it, like, okay, so they did make $60 million because I think of new people signing up for the streaming. The hard part, and we've talked about this for years now on Netflix, that you don't get that box office thing. You get people signing up, and then once they sign up, you get the monthly revenue. But how do you then start saying, okay, well, for Black Widow, because, hey, it was like 6 months down the road, and how do you say?
Well, Disney charges $30 to watch Black Widow.
It's not like Netflix was.
No, so for their big kind of movies they do box office, they do charge $30 to actually view Black Widow. So that's how they made so much money off of Black Widow. It wasn't new subscribers. It was people actually paid the $30, and it's 20 or 30. I believe it's 30 to view it.
Is that on top of Disney Plus? Wow. Yeah. That is pretty amazing. Yeah, and now I'm even more on her side because, you're charging for that, but you're not sharing with her. And actually, I did read also, too, that Eisner, and I think it was the CFO, their bonuses are tied to how much increase or how much revenue they get from the streaming side. so they want that more. And like, sorry, Scarlett, we're going to not take care about you. We're more concerned about our bonuses. So the whole thing is really kind of.
And the thing that I thought was interesting, too, is Disney called out how much she made.
Yeah.
They said, well, she's made $20 million. And it's like, Disney, you make billions of dollars. And I don't have a problem, obviously, with corporate profits.
No.
You know, I do think actresses and actors many times are overpaid, in my opinion, but, you know, that's up for debate. But the thing I look at here is you did circumvent the contract to favor yourself and favor your new streaming platform. And now I think she has merit in the lawsuit because it's like, well, streaming wasn't around. And the crazy thing is, what her lawyers are claiming is that they did try and renegotiate the contract in 2019.
Oh, really?
Yeah. But Disney never got back to her. So I just think it's wrong.
And the other thing, too, that's in her favor is that Warner Brothers, they did go through all their contracts, and I guess they laid out like $200 million for all their actors and actresses because they realized that, this is going to kind of cut you guys out. So rather than doing what Disney's doing to Scarlett, they actually paid all their people. And again, I think it was like $200 million Warner Brothers gave up for that reason. So I think Disney's going to lose here, and I think they're going to come back and say, oh, we're sorry.
But the thing that I think is interesting here is I don't know why Disney just didn't pay her. Because now you have, if I'm an actor or an actress, it's like, I don't know, Disney doesn't really treat their actors that well.
Yeah.
I'm going to go do a movie with Warner Brothers instead. So I think it could hurt them in the long run. And especially you got an actress that's well known like Scarlett Johansson, and she's probably never going to work with Disney again.
No, you know? No. And again, how many other actors and actresses will say, I don't want to work with Disney because they screw people over. They try to, and again, they're actors and actresses. Yes, they have lawyers, but still you're afraid of them working with with Disney because you're afraid, what are they going to do to kind of screw me over? So I do think that Disney will come out and apologize. And I think I think you said she made $20 million. I think she could have made up to $50 million. Again, an awful lot of money, yes. But still, that was in the contract, so therefore you don't try to change what you did. And yes, times have changed, but you still try to take care of your employees or who's ever working for, making you all this money is what they need to do.
Yeah, and I was baffled they brought up the pandemic, and it's like you're making her out to be this monster, and it's like, I don't know the lady, but she seems nice enough.
I wonder who the silly person was that came up with that. Like, well, let's talk about, how she's doing this to pandemic, as opposed to saying, maybe we should look at this and do something else, or, well, sorry, that's where the contract was. But you make excuses for things. I think it makes you look worse, and I think they will come out probably this week with something different because it's not going to die down.
Most of the time, companies just say this lawsuit has no merit. End of story.
Right. The phone's ringing. Oh, I think it's Scarlett. She probably wants us to manage her extra $30 million if she gets it for her. But yeah, just a shame that things have like that in contract. But, we have talked a lot about inflation. People know inflation is out there and some concerns about 1970s like inflation. But there's a very interesting point here is a change to CPI when it comes to the calculation of housing prices. Now, back in 1979, the CPI increased 11.3%, and existing housing prices climbed 14%. Now, compare that to the last 12 months, and the CPI has climbed 5.4%, but yet existing home prices, well, they're up 23%.
Yeah, and the thing that people have to understand here is the difference between the two reports is that the CPI now looks at an owner rent index to calculate housing prices rather than the existing home prices. This index, the housing rent equivalent index, has only climbed 2.3% this past year, which is far below the 23% climb in housing prices. And the big thing here is housing occupies about 25% of CPI, which means if we calculated CPI as we did back in the 1970s, it is likely inflation would have reached double digits. I mean, you could have seen whoa, my goodness.
Yeah.
And
12% inflation, yeah.
And what I do think this is, and we did a long drive up to Simi Valley this last week. We were talking about this on the way up there was, what do we think is more fair? Do you think it is more fair to have the existing home prices or the owner rent equivalent as the measure for housing costs?
Yeah, and I think what they have now is good because what's going to happen is that when the housing prices increases, you're a person buying that house to rent it out. You're going to pay a higher price. You're going to adjust your rent for that. So we'll get into the rent eventually. But if you're using the purchase of the homes, well, that's only a one-time thing that really, well, maybe you buy, 3 or 4 homes in your lifetime, but most of the time it's only going to be a one-time thing over a long period of time. It doesn't really reflect it. And what is amazing, as you point out, the 25% of the CPI makes up, and there's like 170 components in there. So this is a very big one. It's a very important one. And again, it is part of, it probably is your biggest expenditure is your home. So I get that point. But I am glad to see that they are now using the rent side versus the purchasing the home. I think it makes more sense. But again, comparison purposes, why we're talking about this.
Yeah, and the other thing, too, is you talk about there's not that many times you purchase a home in your lifetime. And also think about the supply right now is so constrained because there's not that many people buying homes right now. Yeah. So it's not like it's affecting everyone. So I do agree in that regard. But the thing that it is doing is it does make the housing prices less volatile. So what I think is going to happen here with the rent index is I think you're going to see that elevate next year, and then it's going to be dragged out over time as well because, well, you never got that 25% spike that you saw in housing prices, and that needs to be reflected over time because people don't just buy homes and say, wow, housing prices went up 25%. I'm just not going to increase the rents. I mean, you got to look at your cash flow on it, especially if you're a new owner of that home. You need to get yield off of it. You need to raise the rent. And then if you are a different landlord, and you say, well, their rent's at $4,000, mine's only at $3,500, and we have like the same house. Yeah, I'm going to increase mine to $4,000.
Right.
So over time, that's going to kind of increase this rent equivalent index. And I think it is going to prolong the inflation. I just think it's going to reduce the spikes that we see.
Right, and I don't think it's going to happen as quickly. And I'm not a landlord. I don't want the hassle of being a landlord. But I would think that if you're charging somebody $3,500 a month, somebody else is $4,000. You may not want to just jump to $4,000 because you don't want to lose that good tenant. Because I mean, as I've said before, I would never rent in California or be a landlord. Because I think the laws are so in favor of the rentee versus the rentor, and again we have heard some terrible stories about how the people just living in homes and they can't get out of them. I mean, even right now,
that's worse.
Yeah, it's worse. And again, you're not collecting the rent. I did see over the weekend that this expires too on Monday. The what do they call it? The rent abatement, to where I guess you're going to evict people.
Expires today.
Oh, today?
Today's the 31st.
Oh, okay. So I thought, I think you're right, and I think they probably think it won't happen until Monday.
Yeah.
But today, and that's could be a situation. No?
Not in California though.
Well,
Newsom has expanded it.
Well, he's expanded it, but is he real? So he actually expanded it so you can evict someone in California.
Yeah.
Okay.
So on a nationwide level, it expires today, but I don't have the date. I know Newsom did expand that.
So in other words, landlords still have to carry people not paying the rent.
Yes.
Yeah. And I did hear too or I did read that there's like $47 billion that was out there from the federal government to actually pay the people, to the landlords, but the states and municipalities, I guess, are having a hard time getting it to the landlords. So it's really a mess. The whole thing's a mess.
Yeah, California expanded to September 30th.
Okay, it's about 2 months.
Yep.
Yeah.
So. Yeah, but point is, I mean, that makes it very hard to be a landlord because you're not getting cash flow from your assets. So
and you used to got to pay the taxes, you used to got to pay the mortgage and everything else. So we kind of go off track on that a little bit, but it's just it is back to the inflation part. I think it is better with the rent.
Yeah, it is. And the other thing that I think is interesting is it's not a just comparison, as we said. So, I mean, we talk about this runaway inflation, and it's okay, it's not going to be as bad as the 1970s. Well, you're comparing apples to oranges here because you got such a drastic difference in the housing, which is the largest component of it. And it's not really a fair comparison at the end of it. Our inflation is very, very high right now. I do know the 70s was a little bit more of a sustained inflation. I don't think we're going to see that. I think, again, we're going to see this spike and a drastic spike, and then it is going to ease. And I do know that the PCE, which is the personal consumption expenditures, that's the Fed's preferred measure for inflation. That also came out this past week, and it was the highest in decades. I mean, we haven't seen this in years.
Yeah,
this level of inflation growth.
I mean, there's no doubt that inflation's there, and we're just trying to show you how to measure it. That it's not as bad as it was in the 70s. Well, you kind of move things around. Maybe it was when you do the same comparison. So,
and the other thing too to think about with inflation is if you look at a lot of these companies reporting earnings right now. What are they talking about? Inflation.
Yeah.
I know Procter and Gamble came out and they're
P&G.
talking about their razors, their Gillette, and they raised prices. And they're like, "Oh, we got to raise prices again," and that's inflation.
Yeah,
and they're not the only ones.
And they have to because of the cost of materials. You can't get materials. You know, the shipping of it. You can't get things shipped sometimes. I mean, it's really causing a problem. And a lot of it is because we can't get people back to work because they get paid a very good amount for staying home, which kind of brings me back to the why people aren't paying their rent. I don't get that because if you're getting all this money from not working.
You got to get the new iPhone, obviously.
Well, I guess you spend it on other things as opposed to your rent, which, you know, but yeah, I mean, you're getting, what do we say? Is it $3,000 a month, $4,000 a month? You can begin on unemployment and you still can't pay your rent. I don't know. Something's strange there. Do you think some people are taking advantage of the system?
Maybe.
All right. Well, let's move on. By the way, phone numbers here. We're going to have all lines open. Well, actually, all lines open now. 866-577-2473. That's 866-577-2473. That will get you through for your unbiased, no strings attached, firm opinion about what you want to talk about.
I did want to talk, kind of going backwards on this inflation thing, is the reason this is so important is because what happens is with inflation, the Fed's going to have to raise interest rates.
Right.
And I hope they're not missing the mark here, because what happened in the 70s was they missed the mark on inflation and they had to increase interest rates at an astronomical rate. And then it crushed, you know, bonds, it crushed the economy. Yeah. I mean, it was very, very difficult to overcome. I don't think we would go through the same thing, but then you can't just have runaway inflation, because now that really affects the lower and lower middle class, because, well, they can't keep up with that inflation.
Yeah.
And it really creates these big problems. So that's why I do know that we need to have interest rates increase at a reasonable rate. And that's why I said I really hope the Fed's not missing the mark here. I hope that they do start to look at increasing them probably next year, is my estimation. And the big thing that we keep talking about, this benefits value investing. It's going to probably, in history it has, hurt growth investing, and it's going to hurt bonds as well.
Right. And also, too, you bring up a very good point because of how things change. And I'm very worried, like you, is that if the Fed does get behind, and they did say they're going to, I think they said they're talking about it, or they're going to be pulling back on their purchasing of the bonds and so forth, which is a step in the right direction.
Yeah.
But you're right, if you get too far behind, you try to play catch up, that really causes problems. So something you got to be careful there. Also, too, we are seeing shortages here in the U.S. on products like refrigerators and cars, and we're also concerned about the rising U.S. debt. Well, there's another concern that is not being talked about currently, and that is the trade deficit.
And our economy, as it continues to grow, it's growing far ahead of the rest of the world. We will have a large appetite for foreign goods to fulfill our needs, but yet the world is not ready to buy our goods. What this means is, unfortunately, going forward, this will create larger trade deficits and more of our dollars going overseas. As we said, we're having these supply issues, these supply bottlenecks. Mm-hmm. So it's like, well, we can't produce it here, so yeah, we're going to have to go to China to get these products.
Right.
It does create those problems because we're flowing across to different areas, and we want to have our country get back on its feet, because if we're not manufacturing goods here, well, now we're losing jobs overseas. Mm-hmm. They might not come back as quickly.
And when you send that money overseas, it doesn't come back. I mean, and that's a problem that people don't realize. And it doesn't hurt now, but we've talked about 20, 30 years down the road where other countries own our country because we send all our money over to them. And that's the problem. That's why we want to try to manufacture as much as we can here. But it is an issue because we have all this money, and I think in the economy, the M2, the liquid money, is what $20.4 trillion, I believe, is the number that we have now. So people want to buy refrigerators, they want to buy cars. I mean, almost anything you want to buy, it's like it's in short supply. So therefore, well, let's have the rest of the world make it. So it helps them out. But again, sending our money over there, and they're not buying our products. Now, we'll shift eventually, but again, we'll probably send trillions and trillions and trillions of dollars overseas, which I don't like seeing because it can hurt us it will hurt us long term.
Well, the nice thing is just a few $1 trillion. That doesn't even matter anymore.
What's right now?
So it's just a few $1 trillion. That doesn't matter anymore. It just here's $1 trillion there, $1 trillion. Yeah. Let's just give out money. It's fine.
Yeah, it used to be like billions. Now, like, oh, who cares? It's $3 trillion. Who cares? Yeah, so inflation. That's what inflation shows. So, hey, and I do want to mention that before we go to the calls, our YouTube video. We did a great one on Friday, and I think a lot of people are liking doing that. Did we do it once a week on a Friday?
Yeah, we're doing that YouTube video now once a week. We talked about, such a big thing here is that the semiconductor shortage. And we know it's a big problem. And we looked at this company. It's a San Diego-based company, too, that I think it could look pretty good. And we have, I think, a good opportunity. It takes a little bit more research, but I highly recommend going to our YouTube channel again, Smart Investing with Brent and Chase Wilsey. You can subscribe there, look for our past videos on different companies. It's kind of like the show here. We just pick a good company and we break that down for people, have a good conversation about the semiconductor shortage. Again, that's Smart Investing with Brent and Chase Wilsey on YouTube, and become a smart investor.
And I don't know at the time. I think they're usually, about 10-minute conversation?
Say about 10, 15 minutes.
Yeah, we try to be educational, try to point out more things to help people become smarter investors and so forth. So phone number is 866-577-2473. That's 866-577-2473. And before we go to the calls, I do want to mention we got the workshop coming up here. It's going to be August, and here we are again. It. Thursday evening, August 26th at 6, we'll be holding our Smart Investing Workshop, showing you how we invest our money and our clients' money as well. I've been in the finance world for over 40 years, so I've seen a thing or two, and we'll be sharing with you tons of information. We will be discussing the question I hear a lot today: do you think there's a correction coming? We'll talk about that. How important is compounding for investors? It's amazing when you really look at this. Going to show you how it works. We'll also give you our thoughts on the current inflationary environment. We'll also give you in detail what all these numbers mean that we talk about here in the show and TV and everything else, and which ones you should be concerned with. It is a free workshop, but you must register. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com, or call the office 858-546-4306. That's 858-546-4306, and talk to Brianna. She'll get you signed up. And again, looking forward to seeing you on Thursday evening, 6 o'clock, August 26th, talking about investing, finance, money, making you a smarter investor. All right. Again, phone number is 866-577-2473. I know we did have a call from David who hung up, but I guess he had a comment on
being a landlord.
Being a landlord, yeah. So I don't know if he couldn't wait. Maybe it's in the sometimes people call when they're at the store and they're waiting in line and then they got to hang up. So David, I'd kind of be curious to hear your comments as a landlord. But let's go out to San Diego and speak with Art. Art, you're in the Smart Investor with Brent Chase. How can we help you?
Hey, good morning, guys. How's it going?
Good. How you doing?
I'm good. I'm calling about UPS.
Okay. And do you hold that or looking at buying that?
Yes, I hold it. I bought it at around 100, and I kind of feel like I missed my chance to sell high. It's well off its highs now, but I wanted to see what you guys thought of it at this point.
And I'm not sure. I believe they reported earnings or reports came out about them and Federal Express that they are seeing the shipping decline because they're saying more people are going back to the store. So I believe that was what kind of hurt to both UPS and Federal Express. But let's take a look at the numbers here to see where we stand as far as it's a good investment or overpriced or where we stand. Symbol is UPS. A PE ratio is expensive here, Art. It's 27.7. That's above the expensive industry at 24.9. We do see price of sales 1.8 versus 1.4. Price to book value, very expensive, 32. I say that because the industry is at 10.9. And then price of cash flow, 18.7, well above the industry at 11.1. Now, you do get a decent dividend from them, and I say decent as 2.1%. That is above the 10-year Treasury. UPS uses 44% of the earnings to pay that out. Now, sales, and let me see, these numbers are as of June 30th, so we do have new numbers here. Sales year over year were up 19.5%. That's above the industry at 17.9. Earnings per share did climb by 37.4, but that's below the industry growth at 70%. Looking at the balance sheet, they got a current ratio of 1.4, same as the industry. The debt to equity for UPS has always bothered me. It's 209 versus 119. I don't know if there's something else strange on there or not, but that's just a heavy debt to equity. We don't like seeing it at much above a 120 or 130 level. Looking at the return on equity, 80 versus 32. So now I'm thinking that, okay, maybe they have very low equity. Maybe that's why the debt to equity is so high, because 80% return on equity is very high. Net profit margin, well, that checks in at 6.6 versus 5.4. And then receivable turnover, 9.6 versus 8.4. So, I mean, not great numbers, but not bad numbers. Chase, what do you see going forward?
Yeah, so starting with the current price here for UPS is $191.81. 52-week high, well, that's $219.59. And 52-week low is $135.15. If I go out to December 2022, I see estimated earnings per share of $11.60. Would give us a target sell price right near the current price, as it's $192.56. And again, a reminder, current price $191.81, so we're talking about call it 70 cents away from our target sell price.
Yeah, so
and I do know that they've kind of struggled after their earnings release, and they beat, but then the guidance wasn't as great. They didn't beat by maybe as much as some analysts were thinking, so they did pull back. I do also know that Amazon reported this last week good numbers, but then disappointing guidance going forward. And I think what's happening is we know that shipping and people shopping online is here to stay. That's not going anywhere. But I think a lot of that growth was pulled forward during the pandemic. And now, yeah, we'll still grow the online shopping,
right,
but it's not going to be at these exorbitant rates that we saw during COVID. And I think this is weighing on the stock. I do think there could be some opportunities down the road if they continue to pull back, but right now it appears to be fairly valued.
And also, too, I mean, one thing we talk about, it's not a decline in the sales. It's a decline in the growth of those sales. So it's actually happening. I think Amazon's like 40, and it was only going 20 or something. Same thing with UPS. So they're not declining, but the sales growth is declining. And I actually did look at the, for your art, I looked at the balance sheet here for you. Now, some good things here. I mean, actually, the debt a year ago was $26 billion. It is down to $22 billion. And the equity has actually gone up from $4.3 billion to $10.8 billion. So UPS is turning that around. But as Chase said, it's pretty much, what would you say, 40 cents away from the target sell price?
70 cents.
Yeah. And what was that? What was the high recently? I mean, did it
$219.59.
Okay, yeah. So I mean, you kind of missed the top there, Art. But I think, again, it could turn around, and go back up. But I would prefer that I would say, you know what? Let me take my profits here. It is trading very close to target sell price. Let me take my profits and try to find something else that's more reasonable. How long have you held it, Art?
Probably 18 months now. And, I came really close to selling it at that top, but it's in a taxable account. So I delayed and didn't do it. And now, we're $30 off the high.
Yep. And sometimes taxes, we try to explain it. And I think we're going to do a chart on this on the next workshop to show people that the taxes that you pay, the thing that people don't realize, I'm going to pay this amount in taxes. But that's only on your gain, whereas when you lose 10%, that's on the entire amount. So many times people do the differences, and it's like, and we say at our firm, we'll never make a tax decision over economic decision, because had you sold UPS at that price and say you turned around, you bought something else at 10, 12 times earnings, how far ahead you would be 2-3 years down the road. So, but I would still say if it hits the target sell price now, probably get out and look for something at a better price.
I guess I had to learn that lesson again. Hey, thanks a lot, guys.
You're welcome, Art. Thanks for calling. Bye-bye.
Bye-bye.
All right. That does open the phone line, 866-577-2473. That's 866-577-2473.
I mean, just kind of talking about the taxes, actually, just kind of pulled some numbers together here real quick. Probably make it more expansive on our workshop.
Yeah.
But what this is, I look at saying, just really simplistic. If you bought a stock at $5,000, or you bought you spent $5,000,
invested $5,000,
and it went up to $10,000, so you made 100% profit,
right?
And let's just say it was long-term gains. If you paid 20% on the capital gains, so you paid 20% on $5,000, you pay $1,000 in taxes, and not everyone pays.
Wait. Okay, because it's only on the $5,000. Okay,
yeah. So you'd pay $1,000 on taxes for that growth, assuming a 20% tax rate, which not everybody pays. Some people pay more, especially here in California.
Some pay less.
Some pay less. Yeah. I'd say many pay less. But that means that the stock would have to go down 10% to actually break even, which is very, very realistic.
Well, I guess since you told it now, we don't need to do it at the workshop. We'll still do the workshop and explain more detail. And it is important that people, I'm not paying taxes and so forth. You brought up the concept of what you actually look at. And also, too, and as I brought out, talking with Art, that also, too, what are you missing by buying a better company or lower price company that's going to do better for you 2-3 years down the road?
Yeah, because it doesn't even mean that UPS would have to go down 10%. If you have the opportunity cost of another company increasing, let's say 20%, and UPS just plateaus, it would have been better off paying the taxes there.
Yeah.
So that's where it's always hard because nobody likes paying taxes. I know that the old adage is there's two things that are certain in life: death and taxes.
That's right.
And it is part of it. So people try and avoid it, but sometimes you try and get too cute, too fancy with it. Sometimes, we tell people it's not bad when you pay taxes because that means you made money.
Yeah.
But, it's a difficult decision.
And I'm getting an internal error has occurred.
Just hit back.
Just hit back?
Yep.
Okay, yeah, but it takes me back to the last company is what the problem is. So.
You should just, yeah.
Yeah. So because I see we got Joe in Oceanside here. So, Joe always talks quite a bit. So maybe we'll go to Joe in Oceanside and I'll try to get this fixed here while I'm doing this here. We got Joe on there.
Yeah, good morning.
Good morning, Joe. How you doing?
Doing great. UPS, Brent, you've always had a problem with their debt, and, but they've always gone up in price, and, they've been in business over 100 years, so,
I will say I think I can say this, we did look at FedEx because their debt was much better, and FedEx was a great company for us there.
Yeah, we did. Got to be careful what we say here from the.
We did hold it, and we did well on it.
We were happy with the returns on it.
And we still stuck to the discipline of avoiding the high debt to equity with UPS.
That's right. How you doing, Joe? What can I do for you?
Which hasn't hurt the company either, because like I said, they've gone up a lot.
Yeah, and that's why I looked at the balance sheet too. I mean, the balance sheet's not horrendous, and again, they are bringing the debt under control. I'll put it that way. But it may not hurt this time, but you can't say, well, it didn't hurt this time, it'll never hurt. You never want high debt companies, and it doesn't mean every company's going to be hurt by it, but you still got to be careful with it. And I'm glad. I mean, UPS is...
And their debt to equity has improved a lot.
Yeah.
So that's one thing, too, is, like AT&T, we wouldn't buy for years because their debt to equity is horrendous.
Right.
Well, they've been able to pay off a lot of debt, so now it actually looks kind of more interesting.
Yeah.
So I would say that, you can't always be right on it. A lot of companies fix that balance sheet, but we always stick to that discipline of the debt to equity. Doesn't mean that the stock's not going to do well. I'd love to say, debt to equity is 200, it's going to do terrible. We know that means we're going to miss some things, but we always stick to that discipline. And as I said, sometimes it means we do miss things.
Yeah, and there have been companies like General Motors, like Macy's, like a lot of other companies that the debt did tear down the company. So you should never make an excuse for it just because of that. But anyway, Joe, how can we help you? I'm sorry, we got way off track here for you. What can we do to help you out?
And one more thing, though, is that Delta variant, if that comes back strong enough to, have some sort of pullback as far as lockdowns, masks, whatever, that could help the company price raise as well. So,
yeah.
But I called up with the F, not the acronym, but the symbol F for Ford.
Okay, and do you hold that or looking to buy that?
I just picked it up. I was going to do a swing trade on it, and I probably should have because it just pulled back because it had good earnings. But, I still might get rid of it and just buy because, I think like yourself, we're going to have a correction, so I'd rather just get stuff lower anyway. So
yeah. Well, and again, the correction could be Monday, could be like 6 months from now. But, again, always be good to be prepared for it. So let's take a look at the Ford Motor Company. Their symbol is F as in Ford. Good start here, Joe. I mean, PE ratio 16.5 versus 73. Price to sales, very good, 0.4 versus 3. Price to book value, 1.6 versus 8.1. And then price to cash flow, 5 versus 19. So the valuation ratios on Ford looking very, very good. They do not pay a dividend. I was kind of surprised. I don't think they announced it. I thought maybe they would pay one or announce the payment this time. They did not, so maybe it'll be in the next quarter, but we'll see on that. Sales were up 4.6%, just above the industry at 4.1%. Big turnaround in earnings per share year over year, last 12 months, up 264%. The industry was up 600%. The balance sheet for Ford, you got a current ratio of 1.2 versus 1.3 for the industry. Now, debt to equity, 423 versus 156. But again, this is different. because they do carry their accounts receivables for the car loans that they actually make. We do see return on equity looking okay at 10.4. I say okay because the industry is 11.7. Net profit margin 2.5, about half the industry at 4.1. And then receivable turnover 15.3, very good compared to the industry at 3.5. And inventory turnover 10.3 versus 9. Chase, what do you got for the earnings going forward?
Yeah, so current price for Ford Motor Company here, $13.95. 52-week high, well, that's $16.46, and well off the 52-week low here of $6.41. I go out to December 2022. I see estimated earnings per share of $1.84. It would give us a target sale price of $30.54. And one thing to point out here is this is one thing that we've always kind of battled with these auto manufacturers is they're so cyclical. Is will they reach that 16.6 multiple? That's something that you got to kind of consider here. And I know that General Motors has a lot of potential for like subscription revenue, and if the auto industry is able to kind of get into more of a consistent revenue stream, I think there's no reason why they shouldn't be trading at higher multiples, like Tesla, for example. But I do want to know more about Ford's kind of business lines. I know that they're actually doing quite well. I talked about the Ford Mustang Mach-E. I was wrong on that. I think it is a lot nicer than at first. I was like, oh, that thing's hideous. And now I'm like, I think it looks pretty cool. Yeah.
That kind of grows in.
And I think the Broncos doing well for them. They report some good earnings this past week. I will be interested to see how GM does this week to see kind of more of a comparison of the two large auto manufacturers here.
And I got to say, Joe, I think Ford has really done a great job over the past year or two really turning themselves around, because for a while, like, oh, Ford was terrible. They've really done some great things. I think they put a lot of money in R&D, came out with the new, again, the Ford Mustang Mach-E, the Lightning F-150. So they have done a good job. I think it's worth holding on, and also, too, with the car manufacturers, because so much is going forward with subscription type services and so forth. I think they're changing the business model to help them. So I don't know if I would sell it myself, Joe. I know you're more of a trader than we are, but I think I like the company. I think I'll hold on to it. By the way, what do you drive for a vehicle, Joe?
Well, I drive a couple of old Hondas, actually.
Really?
Okay. and the bike, right?
Before I bought the stock,
Okay. Well, you're a smart man. I mean, you waste a lot of money on cars, and that's my fault. Is I love cars, and I know it's not very profitable, but I just have that thing. But smart driving cars and Hondas, I think, are them and Toyota. I think
they're great values.
Great values, yeah. So you're a value car driver. But you like to play the market a little bit, though, Joe.
Well, I did pick up that motorcycle too. I was telling you about that one time. I did pick that up new. So
that's right.
But GM. I wonder how the recall is if that's gonna affect their earnings at all as well. And Ford, whole thing, like you said, Brent. If we do have a pullback, I could just take a small profit now and just hold the powder until maybe that happens and get it at a better price.
It could be, but what if GM reports good earnings, brings Ford up another, 2, 4, 5%, and then you miss that growth, and then the thing I don't like about trading is that you never know. Sometimes you're right, sometimes you're not. I know trading is a lot more exciting than what we do, but I'm more excited about making good money long term. And my concern is if you sell it now and it goes up, we'll say another 5, 10%. Then it pulls back 10%. Well, 10% of a higher amount won't be as much. So you get in this thing, and then I don't know if it's taxable account you're dealing with, but I just tried doing trading many, many years ago when I first started. Like, this is crazy. I have no justice for it. And again, the correction could come next week because there's some things coming out, but there's a lot of money out there in the economy, and it seems every time things drop a little bit, there is somebody there to buy another low price. So that's why I'm cautious. So.
Yeah, I bought it in two separate accounts. I bought 2 separate accounts, and they're taxable accounts. These ones are.
Yep.
So, it's just, So, you'd hold it basically, huh? Wow.
Yep. Well, go, okay. Joe. Good talking to you there. Thanks for calling in, and we'll see what you do. Let us know if you sell that Ford.
I will. We'll talk to you next time.
Okay. Bye-bye. All right. That does open the phone line, 866-577-2473. That's 866-577-2473. And
it is going to be interesting when GM does report next week. As you said, Ford didn't bring back the dividend. What if GM brings back the dividend?
I think they will. I think you said you might think it might be September.
Yeah.
Well, actually, this is August. This is August.
Yeah, this is the start of the third. I said I thought it'd be third quarter, which would be
that would
now.
be October. Well, okay, the start of the third quarter. I thought you meant the end of the third quarter. So which would be October. So we'll see. And we have seen some companies bring back the dividend.
Yeah.
I know that Chevy had the recall on the Bolt. I don't think it'd be that big of a.
I mean, I don't think the Bolt is that percentage-wise. It doesn't make up a ton of their sales, and it's not like GM hasn't dealt with recalls before. I think they're probably pretty efficient with the recalls now.
Recalls, yeah. And again, they're making so much money, I think, off the trucks and the SUVs that I got my fingers crossed they bring it back, and we'll see it. And you're right, if they bring it back and Ford doesn't, Ford can bring it back, I guess, midstream. Don't have to wait till the quarter. So, all righty. Phone number is 866-577-2473. That's 866-577-2473. Let's talk to our financial planner, Harrison Johnson, about pension lump sum versus pension guaranteed income. This is so important. Good morning, Harrison. How you doing this morning?
Hey, guys. Good morning. How you doing?
Great. I love this topic because this is something a lot of people deal with. Do I take the lump sum? Do I do the pension guaranteed income? What I do here, kind of help us out.
Yeah, and actually, I take a look at this quite a bit. I know a lot of people don't have pensions now as much as they used to, but I still work with a lot of government employees, and there are still some companies out there that still offer them. And so when you get closer to retirement, that's the big question. Do you want to take the guaranteed income with the annuity, or do you want to take the lump sum? On the annuity side, there's usually a whole bunch of different options you can go with, single life, joint life, period certain, refund option, term certain, all that stuff. Or you take the lump sum and roll it into an IRA. And so there are a few things that you need to look at, because in some cases the annuity makes sense, and in some cases the lump sum is better. But I always want to look at the payout ratio, which is the annual payment that you can get from the annuity side divided by the lump sum. That will give you a good idea of how much you're getting out of that principal. Also, you have to understand, well, what other assets do you have? How old are you? What other income sources do you have? What does your tax situation look like? Because, again, it really depends on the individual situation. But, with the annuity side, the big draw is, well, it's guaranteed. As long as I'm living, I get to withdraw that check. I don't have to worry about market volatility. I don't have to worry about any of that stuff. So it's always going to be coming into me every single month. On the lump sum side, you get a lot more flexibility, and in some cases, you have the chance to earn a higher rate of return, which turns into more income for yourself. But also beyond that, when you take the lump sum, you also get some more tax planning opportunities, because you can choose, well, how much am I going to take in these years? Maybe I'll slow down in these years. Maybe I'll make some conversions in these years. So you get a whole lot more flexibility, because whether you take the annuity or the lump sum, it's all going to be ordinary income when you withdraw it. And if you can defer some of that ordinary income or convert some of it, sometimes that helps out your long-term tax situation. Also, with the lump sum option, when that's in an IRA, after you pass, those assets stay in your estate and they go on to the next generation. Sometimes that's important to people. So you get a lot more control of the principal as opposed to just taking that income. Sometimes if you pass away too soon after you've taken the income, then it's gone, and there's nothing left over. So the other day, I looked at a situation where a husband and wife, they're a 65 couple, getting ready to retire, and they were looking at a joint annuity from a pension, the guaranteed income, and so they could get just under $2,000 a month. It was $1,968 a month, or they could take a lump sum option of $500,000. And so the payout ratio of that was 4.72%. So basically that $1,968 a month is a little bit less than 5% annually of that $500,000 lump sum option. And so what we looked at is to say, well, if you took that $500,000, put it into an IRA, and then withdrew the same monthly amount from it for 30 years, the span of your retirement, as long as we can invest that money and earn more than 2.4% per year on average, then you come out ahead taking the lump sum. And then again, on top of that, you can choose how much you want to take. Maybe you want to convert some and kind of go that way. And so that's an example of when a lump sum might be a whole lot better. Now, sometimes we see the annuity that's offering like a 15% payout ratio, and in that cases, that's tough to say no to. So it really comes down to the numbers and the overall situation.
And Harrison, and I've never been on favor of the annuity side because I just don't like to give up my flexibility, and you don't know how to kind of value that. But I mean, one thing I think about, like, okay, so you took the $500,000, and say down the road you get, I don't know, some type of cancer or something, and the amount to do it is like $50,000 because your insurance won't cover it. Well, you could use that money for that. If you took the annuity side, you have no access to that money. I mean, it's gone. It's just a contract for that company. So that's one thing I always look at. I know sometimes the annuity payouts are higher. And again, this is what you do. You explain all the reasons to people, let them decide. My decision is I would never give up my flexibility.
That's also because you invest. I do look at if somebody's like, I'm just going to take the lump sum and put it in cash, then don't do that. But the nice thing, too, is I think, I don't know if you mentioned already, Harrison, but the estate side of it is if you have a kid, let's say, and you take the annuity option and unfortunately you pass away in 2 years, well, your kid gets nothing.
It's nothing. Yeah.
And you definitely did not get your money's worth.
So taking the lump sum is a guaranteed way to make sure you're getting the full value of all the work that you put in for that company.
Yeah, and that would be terrible that you pass away 2 years later and you had $500,000 and it paid out, $24,000 or $48,000. Like, wow, it's all gone. I know there's other options on those as well. You take a lesser amount, you can get it, paid out for a certain time frame, but still, I
was going to say, I don't think there's anything that passed on your kid, but there's like a 10-year certain that you would get that.
Right. That's what I meant. They would get the monthly checks for like 10 years for certain stuff. So there's options to it. But again, as always, Harrison, it comes down to each individual sitting down with that person, explaining to them all the ins and outs of it so they can make a good decision based on good information that you gave them.
Yeah, absolutely. The numbers don't lie, which is the nice thing.
Yep. The numbers tell a story. We all love numbers in our office.
That's right.
Well, Harrison, thank you very much. You have a great weekend. We'll see you on Monday morning.
Thanks, guys. We'll see you Monday.
Okay, bye-bye. All right, again, that's Harrison Johnson. He is our CFP, our financial planner at our office. If you want a free consultation with him, call the office, 858-546-4306. That's 858-546-4306. You can speak with him directly. You can also go to the website, smartinvesting2000.com. That's smartinvesting2000.com. Send him an email. You can talk to him that way as well. All right, phone number's here, 866-577-2473. That's 866-577-2473. And before I go back to the calls, I do see we have Arturo here waiting. So Arturo, just bear with me for another minute because I do want to talk about the workshop coming up on August 26th. It's only a few weeks away. 6 o'clock in the evening, we do have some snacks for you and stuff. So if you get hungry, you're not going to pass out during that. We're going to show you how we invest our money and our clients' money as well. Now, I have been in the finance world for over 40 years, so I share with you a lot of different things I've done over the years. We will be discussing the question I hear a lot lately: do you think there's a correction coming? How important is compounding for investors? We will also give you our thoughts on the current inflationary environment, how that affects the investments, and we'll also go in detail all the numbers that we use for our management that I've been using for over 40 years, and which ones to really be concerned about. It's a free workshop, but you need to register. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com, or call the office, 858-546-4306. That's 858-546-4306. Speak with Brianna. We'll get you signed up, and looking forward to seeing you on Thursday, August 26th, 6 o'clock at the Smart Investing Workshop. All right, as promised, let's go up to Lomita and speak with Arturo. Arturo, you're on the Smart Invest Show, Brent Chase. How can we help you?
Good morning, first of all.
Good morning. How you doing?
Good. First of all, I'd like to thank you guys for taking your precious time to educate us, which an investment, that should be the first priority, to get an education.
Well, thank you. We appreciate that.
And you guys are the tops, the bottom line.
Okay, we like being the top on the bottom line.
Look forward to hear from you guys every Saturday. My question is about the electric vehicle industry, especially the charging stations. Plug been around, went up, and now it's way down. Charge point went up, now it's down. And then there's a new one, the EVGO. Is there any future in those companies? I know the previous caller called and you mentioned something about the electric vehicle industry being cyclical. Are these companies down because they are cyclical, or are they just down because they're out of sync with the market?
I mean, it could be they got ahead of themselves, and I do see down the road, I hate to see this, but I know it's going to come, to where you're going to have maybe less gas stations and more charging stations. And I did hear, I don't know if you saw this, Chase, or not, but that I believe Tesla said they're going to open up their charging stations to other vehicles as well. Did you see that?
I did not see that, no, but that would hurt these companies, obviously.
Yeah.
I mean, because Tesla's got a pretty decent-sized charging network at this point, and, I still don't know what GM and Ford are going to do. Are they going to start building their own? Are they going to kind of sublet some of these other charging stations? So, I mean, that's the hard thing with trying to essentially predict the future here, Artur. There's going to be charging stations. We know that. But who's going to do it? Are the companies going to do it in-house? Are they going to maybe buy some of these companies? There's so many questions with it, and it's going to be a big gamble. And to kind of give you an idea of why I think that the stocks are down so much, I mean, you brought up Plug Power. I looked at the numbers here. I mean, gosh, the current price is $27.28. It went as high as $75.49. But gosh, you look back to the early 2000s, late 90s on a stock price chart, and I've looked at this before, it just blows me away, is it went to a stock adjusted price of near $1,200. It is nowhere near that price any longer. So I think what happened with Plug Power and these other charging networks is, everybody knows that Biden wanted to get involved in the EVs and kind of go that path. Oh, we got to buy. And they didn't even care about the fundamentals. So I think the stocks just got way ahead of themselves. And people said, oh, wait a minute, these aren't really, Plug Power is not worth $75 a share. So it pulled way back. I still do believe they're overpriced, and I could prove to be wrong if Plug Power is the future of the charging networks, but that's the crystal ball is a little foggy for me.
Yeah, and I just pulled up Plug Power real quick, just kind of look at it, and I don't know how this is happening because I thought things were kind of growing. Actually, their revenue year over year is down 125%, earnings down 316%. So, and this company has been around, he said, I think for now, maybe probably 25 years. I'm kind of curious if there's anybody that bought it back at $1,000 still holds it now, hoping for it to come back. Probably not. Yeah. But, I mean, it's more of a speculative type thing when you look at the charging stations. We know they're going to be growing. We know that's going to happen. I do remember I was down on Balboa Avenue about a month or so ago, and I believe it's a Tesla charging station down there, right on, I think, around Genesee and so forth. And there was a line with it had to be like 20, 25 cars waiting to charge your car. So the demand is there for charging stations. The thing is, how are they going to be profitable? You do have a big capital expenditure up front to build those stations. So it's something that I'm not ready to play in, even though I know it's going to do well.
And the other thing, too, is with Tesla, they have their power wall, I know, that you charge at home.
Yeah.
So if that goes that route and we can get super long distances on the charge, it's like, well, I don't need to go to the charging station. I have my own charging station in the house. So.
And that is a great point that Chase brings up, because you're right. If the charging goes from, right now, say it's around 300 miles or so, if it goes up to 1,000 miles, those charging stations, they may go out of existence because they're not needed as much because you can charge so much at home. So these are the things that when you do growth investing, that things look pretty good, but the future can change on you. So I would not be investing with that down the road. So that's why we like to do what we do, because we like to buy food companies and insurance companies and banks because we know what they're doing. So, and I got to ask you, Arturo, what are you by like a road where like a car goes by every time, or what's going on?
Well, no, I was walking my dog, and then I wanted to talk to you guys. So what I did, I just got your answer, and I just pulled off the road, and now I'm parked.
It sounds like you're watching a race or something where cars go racing by every time.
Cars go by, they just sound loud. But thank you very much for your information.
Okay, Arturo.
Look forward to hearing you guys next Saturday.
All right, we'll be here. Thank you for calling. Bye-bye. All right, that does own the phone line, 866-577-2473. That's 866-577-2473. And Chase, I think it was Joe brought up about the return of the COVID, and maybe that could kind of change things a little bit. I did see that. Where did my notes go here? So Karl Rove, who was he was a House he worked in the gosh, I forgot his title now. He had it pulled up, but he's been the chief of staff. That's what he was, chief of staff. So he's been around quite a bit. But he gave some numbers that were, and again, what we try to do for people, again, we love numbers. We try to pick up numbers. You make your own decision what you think. But he points out that currently the chances of going to the hospital from COVID, if you are vaccinated, is 0.003. Now, the death rate from COVID for those that are vaccinated now stands at 0.0005. These are just amazing numbers, and that kind of compares to chances that you have that are just unbelievable.
I mean, you compare that to getting struck by lightning at 0.0007%. That's actually higher than if you were to contract COVID and pass away from it after being vaccinated. And then also the chance of dying from the seasonal flu is just 0.1%. And again, we tell people these are the numbers that we see here. You make your own choices, but that's one reason I don't worry about the lockdowns. I hate to say this, but I do think we are going to see a return of the masks.
Mm-hmm. To some degree.
To some degree. I don't think it's going to be mask everywhere, but I do think that, especially here in California, I wouldn't be surprised to see. I mean, we're already seeing it in LA County. I wouldn't be surprised if San Diego was coming up next, unfortunately, and that's just my opinion. I'm not saying I'm for or against masks. Right. I just wouldn't be surprised to see them. But I think the full-fledged lockdowns, I don't see those coming back. I mean, I think that it's just numbers are there, and it'd be too hard to do that again.
Yeah. And again, when you look at the numbers, and again, they used to talk about the science. Now it's not the science any longer. It talks about, we got to put the mask back on. We got to do this and so forth. They're not using the science anymore. And that's where Karl Rove got this information from. He's looking at, not maybe it's the science, but the numbers, the analysis, the analytical side of it, saying, well, let's really understand what we're doing before we say, well, let's put masks on our kids and everything else again, which I don't want to go too far off on the political side of this, but we're looking at it from how it's going to hurt the businesses and the economy going forward. I think if you go too far with it, you could start hurting the economy.
Well, now I have heard people, I'm so worried about COVID, I'm not going to invest. And that's where I think it's a little foolish, because I'm not worried about what happened last year. And I think people have that recency bias that if we have the Delta variant spread and we lock down the economy, then the stock market's going to crash. I want to be holding cash. And I just don't foresee that. We see a healthy correction coming, but it could come after maybe a 15% climb in the stocks, which would now put you behind where you were today anyways if you just held all cash.
Yeah.
So that's why it's hard to say go all in or go all out. That's why we look for finding good valued businesses, because we always have that intent of investing, but sometimes you just can't find things.
Right.
It's different than trying to time the market, which is, I think, what people are trying to do right here is, it's going to pull back because of the Delta variant. I do think that it's going to be low odds, very, very low odds that we see what occurred last year.
Yeah, I would put the slim to none is what I would probably say.
I'd probably put it about the death rate there.
Yeah, 0. What was it? And what is that? That is,
I'm being facetious, of course.
I know. But 5. What do we say? That's 5 10,000ths, I think, is what it was when you look at the numbers. I mean, it's very, very low, and that's why. And I think there's some people that get so afraid of it and do it. And again, if that's what you want to be, that's okay. But I don't think that the government should actually turn things around, shut things down again. I don't think they will, especially we do have a election season coming up next year. Here in California, we've got the recall coming up in September. I
would just be surprised.
Yeah, I'd be very surprised.
And that's where it comes back to the investing side is don't go to cash because you're worried about the Delta variant.
Yeah. That's an emotional decision, not a analytical decision.
And don't get me wrong, I do think it's going to continue to create volatility with the Delta variant. This happened. Oh, my God. You could see that 5% pullback, and, it's going to create some fear in the market, but I don't think enough to the point where sell everything. So don't sell everything. Didn't want to end on that.
That's right. All right. We're going to take a quick break here. When the second hour of Smart Investing comes up, I look over, I say we got all lines open. So if you want to give us a call, you'll be first up. 866-577-2473. That's 866-577-2473. That'll get you through for your unbiased, no strings attached, fundamental opinion about what you want to talk about. You are listening to Smart Investing Show. Stay with us. We'll be right back. All righty, welcome back to the Smart Investor Show. Gosh, that minute and a half goes by quick. We got to get a couple of sponsors in there to kind of like give us a chance.
We can't do it. People love the show too much.
I know it. And I do say what I say in the beginning, that we sponsor the whole thing to give people more time. But then I look over like no one's calling. What happened? Everybody thinks, well, I'm not going to get on through. Now I'll give you a secret. Right now, if you call, you will get on through. 866-577-2473. That's 866-577-2473. And again, you want to talk about, a company that you're looking at. Again, we call them companies, equities, stocks that you're looking at buying, selling, or holding. Maybe you have a comment about something that's going on or questions about general investing. As Chase has pointed out, I'm afraid I'm going to go to cash because of the correction coming up. We'll talk about that with you. You give us your concerns. We'll discuss them with you. Try to walk you through it.
Absolutely. So, but I do think now we can talk a little bit more about the workshop too coming up. It's going to be here before we know it, and people always ask, "Oh, I missed the last one." Well, here you go. Here's the next one coming right up.
Yep. And these workshops, I mean, I've never had, and I've been doing them for 20 years. I've never had one person saying this was a waste of my time. I didn't learn anything, because we do talk what.
I'm going to say you told me you had people walk out on you during the tech boom.
You know what? You're right. That was different because back during the tech boom, when I was saying that Cisco was too pricey at $65 a share at 2,200 times earnings, people said, "Oh, you're crazy. That's the old accounting. You don't understand the new business and how things work." So you're right. I did have people complain for silly reasons.
Yeah.
Okay. So maybe,
they were also wrong. So you tried to save them.
That's right. That's right. So
unfortunate.
Yeah. But they did complain. So I guess I can't use that anymore because I did have complaints about it. So, but it is going to be Thursday, August 26th at 6:00 in the evening. Again, we'll go over all these different things to make you a smarter investor. And again, come to it. If you're not happy with it, please let us know. We'll give you a refund. Oh, wait, we don't charge for it. So I guess it's free. So it doesn't cost you anything in there. But you will learn a lot of information. We'll talk about a lot of things right now. We'll be talking about the correction. We'll be talking about, compounding, inflation, all these important things that you need to know about when it comes to investing. And most importantly, we show you everything we do and how I've managed money for so many years, what we do. We go over the numbers you hear on the radio show in more detail. We go over the financial statements. We go over how we get target sell prices. We go over so many things to really make you a smart investor. Again, it is free, but what you have to do is you have to register. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Or you can call the office, 858-546-4306. That's 858-546-4306. Talk to Brianna. She'll get you signed up, and we look forward to seeing you August 26th. That's a Thursday evening at 6:00, talking about investing your money.
Yep.
All right. Well, I don't see a name here for the
I'm
gym.
guessing it's Jim in Alpine, but
Jim?
Is that who it is?
Yeah. Okay, so it's not showing that. Let's go to Jim in Alpine. Jim, you're on the Smart Invest Show. Brent Chase, how can we help you out?
Your psychic abilities continue to astound us all.
I just used what's called deductive reasoning. I know call from Alpine, so I said, it's probably Jim. And I looked at the company. I know they probably paid dividends, so I kind of put two and two together there.
Yeah, well, yeah. It's good to be known, even if it's bad news. I think it was Ford that said that. Anyway, I figured you guys were sounding kind of bored. You needed some entertainment, so let me know about Citizens Financial Group.
And how
is my future going to predict my future for me, Swami?
All right, we'll try to do that for you. And again, thank you for calling in there. It is a slow day today. I know everybody is today. It's kind of cloudy outside, but is that symbol CFG?
Yes.
Okay,
that's correct.
All right, because my Reuters is kind of giving me a hard. Oh, here it comes. Okay, because I first put it in, it said internal error, but here it is. Citizens Financial Group Incorporated, symbol CFG. Good start here, Jim. I mean, PE ratio 9.4 versus 11.7. I like seeing that. Good start. Price of sales 2.7 versus 2.9. Price to book value 1.1, well below the industry 1.5, and price of cash flow 10.5 versus not material for the industry. Now, I really like seeing this. They do pay a 3.7% dividend and only use 26% of their earnings to pay that out. So that tells me that dividend is very stable, and that's a pretty good yield, almost 4%. We do see that their sales, unfortunately, down year over year, 15.5%. Industry was up 0.9%, and these numbers are for the period ending June. We do actually see that the earnings per share did grow by 79% year over year for the last 12 months when the industry was up only 14.9%. So that's very attractive. It is a financial company, so no current ratio. Total debt to equity, very good, 30 versus 313. Return on equity, 9.2, just under the industry at 10.7. And then we see net profit margin for Citizens is 29.99. We're going to call it 30 versus the industry at 24.7. Chase, what about the earnings going forward?
Well, I did, of course, figure this is a financial company, given the name of the business, but it is a regional bank. So they're actually in 11 states in the New England, Mid-Atlantic, and Midwest region. So I'm not familiar with them in terms of services, but I do like them being a financial company. I did also find this interesting. The company was founded in 1828.
Wow.
That's been around for a long time.
Yeah.
Well, one of the first colonial banks out there. But looking at the numbers here for Citizens Financial Group, current price $42.85, 52-week highs $51.14, and 52-week low, that's $23.46. I go out to December 2022, I see estimated earnings per share of $4.37. That would give us a target sell price of $72.54. So I like that there, Jim. It's a good value. You get a nice dividend on it. I like the banks. And we've gotten a pullback on the banks, too, which, as I said, I mean, that's a pretty substantial from 51 down to 42. I think it's an interesting time to start looking at these financial companies again because we talked about the rising interest rates that we foresee coming. Who benefits from that generally is your financial businesses. So I like it.
And Jim, the other thing, too, is that I've kind of looked at considering, because we have two money center banks, big banks is what we have, and I have considered looking at some regional banks because they can react a little bit differently, but I think our financial exposure to banks might be a little bit too high because they've gone up. But I think it is an area to look at. If you don't have any banks in your portfolio, the regional banks like a Citizens Bank, I mean, I think it does make some sense to maybe put that in your portfolio. So, and I think you said you hold it. Is that correct?
Yeah, I do. I've got it. I put some calls on it during the pandemic slump, and I think I bought it in at like 29 or something like that.
Oh, good.
But I'd have to go back and look, frankly. But no, it struck me as a nice, stable in 1928. I didn't know about that. Jesus, what was it like back then, Brent?
What's that?
What was it like back then? Was investing the same back then?
Oh, it's much different back then. Percentage-wise, Jim, how much does it make up of your portfolio?
Oh, I don't know. I don't know. I'm going to guess 4 to 5%. Yeah. I mean, something like that. I bought a bunch. It seemed like a good idea at the time. To quote General Custer, and it's been good. I was driving along, and you guys sounded bored, and I said, "Well, I got this stock that I haven't heard much about. I'll call them and ask them." So I have to go back and see what it is. I got one stock that's gone through the roof. It's suddenly 14% of my portfolio, but everything else is down in the single digits.
Good.
So and partially with your help. Again, thank you, as I do every week. Thank you for being there and for being there. It's just that simple.
Well, we appreciate you listening, and we're glad to hear every Saturday. Thank you for calling, and again, I sounds like your portfolio is pretty strong. We like it.
All right. And the rest of you folks, call these people. Come on. Get off.
Yeah. It is definitely a slow day today. I think everybody's still sleeping in bed, maybe. I don't know. Thanks for calling, Jim. Have a good one.
I'll call back in a couple of minutes with a different name.
Take care, Jim. Bye-bye. All right. That does open the phone line. 866-577-2473. That's 866-577-2473. And Chase, it's kind of funny. I've been doing the show now for 28 years. There's just some times that people just slow. I mean, it's like anything.
Yeah, and I did want to point out too, just kind of continuing on with the conversation from Jim here, is he said he bought that company at 29.
Right.
And not only has he gotten the stock appreciation on it, but the dividend yield he got back when it was 29, like right now it's 3.7%. Just kind of did some quick math here. It looks like his dividend yield based off his cost basis about 5.5%. So, I mean, that's a great thing. And if they increase that dividend, well, it's going to be even higher. So that's the thing that people forget about with compounding is as your money grows, it's going to compound and you get these dividends and the company grows those dividends. Right. And this is why investing is so awesome and why it makes people money in the long term.
Yeah. And again, I was reading something last night and they were talking about how they really see over the next the years to come, many banks actually increasing their yield. So Jim's yield could go from he started up, as I said, 5%. It could go up to 6, 7, maybe even 8% yield, as long as the company doesn't go too expensive. But, I mean, that's why I love investing. When you do it properly and you're patient, you can do very well. So that's what it's about. All right, phone number is 866-577-2473. That's 866-577-2473. Let's go up to Temecula and speak with John. John, you're on the Smart Invest Show, Brent Chase. How can we help you?
Hey, good morning, Brent and Chase. Good to hear you.
Good to be there.
Hey, you're talking about banks, and I've been having problems finding some value, and so recently I did find 3 that I thought I liked, and I purchased all 3, and one of them is NWBI, Northwest Bank Shares. It's a smaller regional again, and it's at about a 6% dividend right now. And I thought it was looking pretty good. It's a little high on the PE for them, maybe around 11 or 12, but I think it's still got some legs to it, and looking to increase my holding on that as well.
And John, how long ago did you buy that one?
It was about, I want to say 6 weeks ago.
Okay.
8 weeks ago.
Okay.
Yeah.
All right. Well, I'm excited to look at this one as well. Northwest Bank Shares Incorporated, symbol is NWBI. Good start. PE ratio 10.5 versus 11.8. Price of sales, though, surprised me a little bit high. 3 versus 2.9, not too bad. Price of book value 1.4 versus 1.5. And price of cash flow is 14 versus not material for the industry. Now, you are correct. They do pay a 6% dividend here. But they only use 44% of their earnings to pay that out. So that dividend, to me, seems to be pretty safe there. Sales were up 3.9% year over year over the last 12 months versus 0.1 for the industry. Earnings per share climbed for, 120% for Northwest Bank versus only 14 for the industry. Now, the balance sheet, again, it's a banking company, but their debt to equity only 24.5 versus 313. Return on equity is 10.5 versus 10.7. Net profit margin, checks in at 29.1 versus 24.7. Chase, what are the earnings? I'm liking what I'm seeing here in this bank.
Yeah, and I did kind of look it up because I was curious where they're at. And again, this is another older company. I love looking at some of these banks. Founded in 1896, so another old business here. But they do operate in western Pennsylvania, central Pennsylvania, western New York, and eastern Ohio. So it seems like they're not super diverse there, and it looks like they just operate 170 community banking locations. So it's definitely a smaller bank for sure there, John. The other thing I did find interesting is the company also offers investment management and trust services, employee benefits, and property and casualty insurance. I feel like most of the time those regional banks don't get into those different realms.
Yeah.
So a little bit surprised by that. But let's take a look here at the numbers for Northwest Bank Shares, Inc. Current price $13.34. 52-week high, that's $15.48, and 52-week low is $8.84. If I go to December 2022, I do see estimated earnings per share of 91 cents. Would give us a target sell price of $15.11. So that's about 10-15% away from the current price. Would be in the hold category there for us, John. I wouldn't sell it, but I don't know if I'd add more at this time. If we got a pullback, perhaps this could be a good option there.
Did you get it at a better price, John? You bought it 6 weeks ago, or
I did.
You did?
Yeah, I got a little better price, and honestly, I had some cash sitting on the sidelines, and I said, "Hey, it looks pretty good, even if it only goes up 10%. I think my downside's pretty riskless, and if I can get 6% on it, it's a lot better than the 1.5% or 1% sitting in the bank.
Where are you getting 1% in the bank?
Yeah, right. Yeah, 0.5% or 0.25%. Right?
Yeah, there we go. 0.25% sounds more like it.
Yeah.
But
so that was the main reason I did it. And I looked at to your point. I think the banks should have some great opportunity over the next couple of years, and So I bought one Penwood, which is too small for you guys. It's like $150 million market cap. And then, but Umpqua is another one. If you want to keep the banking going, UMPQ up in the Northwest, I think it's a pretty good opportunity right now too. So those are the three I try to get a little dividend play out of, and hopefully be a long hold for me long term.
Did you say Umpqua?
Yeah, Umpqua. It's UMPQUA.
It's a unique name.
Very unique.
Yeah,
sounds like an Indian name.
I think it's I think it's an Indian name up in the Northwest. Yeah, and the stock symbol is UMPQ. So, and I think they even look a little bit more enticing than the Northwest Bank right now. So
I was going to say on Northwest Bank shares, or what I was going to say on that one, I think because of the large dividend of 6%, you probably won't get a lot of fluctuation in the share price. And again, I don't know much about the bank in general. As long as the bank is doing a good job, you probably won't get a lot of fluctuation up or down on that with that 6% dividend. As I said, they only use 45% of their earnings to pay that out. So it's a pretty good dividend payer. It's actually better than what utilities used to be. So, but again, you probably won't see that
more like
stock
a bond proxy.
Yeah,
right.
Exactly.
Yeah, for me right now.
Yeah.
And the fact that they did those other things that you talked about. Some of the things you wouldn't think about it, right? Casualty and property and life. Some of those other things. I just thought it helped round them out a little bit. So and might give them a little juice on the back end rather than just the banking piece. So
if we had the need for a regional bank, which again we just can't do it because we've got too much in banking right now, but I would definitely look at this one to understand that more because I think it's worth the research.
Yeah.
All ready?
Yep.
John, thanks for calling.
Thanks, guys. Yeah,
right.
Take care.
Bye-bye.
Bye now.
All right, that does open the phone line, 866-577-2473. That's 866-577-2473. Let's go to Valley Center and speak with Chuck. Chuck, you're on the Smart Investor. Brent Chase, how can we help you?
Thank you very much for taking my call. I just want to make a comment on annuities. Mm-hmm. I was sitting on the fence a few years ago, and I thought, being in retirement, that guaranteed monthly income, was a pretty good deal. I could live off what I was going to make. But I talked to my financial advisor and got some more insight. And anyway, I didn't do that. And what has transpired is that I've had to take my required minimum distribution every year for like the 5 or 6 years. Mm-hmm. And it's been between 15 and 21,000. And I just go ahead and throw that in the bank, and then I pull it out when I need it for whatever, or leave it in the bank just, for whatever I want down the road. And the portfolio has always grown back above what the required minimum distribution was that I take the first week of January. And I just kind of wanted to throw that out there for people that might be thinking or listening. I really like my financial advisor. I've been with him now for, he used to be with Washington Mutual before they went south, and he's with his own kind of brokerage company now. And so people might, if they're vacillating about an annuity, and I know all situations are different for all people, but I've been very pleased that my portfolio's gone back up above what it was after I take my minimum distribution every year. And that doesn't mean it's going to happen in the future, right. But, I've still got all my basic principal plus, right. and I've been able to take that RMD, every year, right. as required by the government. So it's been a good thing for me not to do it.
And Chuck, and I think what you point out is that it did work well for you. You're glad you didn't choose the annuity, but you have had, even though you have a good portfolio, it sounds like, you have had the ups and downs, the good years, the bad years, good quarters, bad quarters. But because you've ridden that through, you've done far better than had done the annuity, I think is what you're saying there, correct?
Well, I'm a lot more comfortable because I still have all my principal, mm-hmm. and every year I still have to take that required minimum distribution, and having to do that and have the portfolio, grow back above what, I take out every year to maintain that principal level. To me, it's just something that I can use down the road, or it goes to my heirs, or whatever the case may be.
Right.
And for me, it was the right decision to make at the right time.
Well, Chuck, we appreciate your comment there. Thanks for calling.
I appreciate your show. Thank you for having it on.
You're welcome. Have a good day. Bye-bye.
You too, sir. Bye-bye.
All right. That opens on the phone line, 866-577-2473. That's 866-577-2473. And Chase, it is nice to kind of hear from people on their personal experiences and stuff and how, again, I mean, that was his experience with the annuity versus investing does work better and stuff. But I do want to point out to people, I mean, there is going to be differences. That's why we talked about, our financial planner, Harrison, to make sure you sit down and talk to somebody about the differences, because it would be a shame if somebody did invest. And I know last March, April, I mean, things dropped dramatically. There's people that panic and sold out. Probably wish they would have taken the annuity, but you got to understand that's why you have to have a good financial advisor with you to weather those storms.
Well, and it's so important too, because you're right. I made the reference about just putting the lump sum in cash. That's not going to pay off, but I'm going to bring up, if you put the lump sum in Bitcoin and it goes down 50%, well, that's not good either.
And Bitcoin's up again, above 40,000 again. I mean, what a stable currency that is.
Yeah.
And I think just a couple of weeks ago it was below 30,000. Yeah. So, gee, we haven't got any calls on Bitcoin. We probably will now that we mentioned it.
I know.
Let's go out to San Diego. Speak with David. David, you're on the Smart Best Show. Brent Chase, how can we help you?
Hey, I'm doing great. How about you? Oh,
good, thank you. Thanks for calling. What's going on?
Okay, just wondering about international paper. I own a small position in that, and with all the junk mail that I get, I thought, well, maybe paper's not too bad. So, anyways, just interested in your views on that.
And it's funny, we looked at this company and other companies similar to it because there could be something with this. It's not, I know what you mean about the junk mail. I know I get a lot of it, but also to cardboard and, what is it called?
Corrugated boxes.
Corrugated boxes, the other thing, too, with all the shipping. Right. So, and I'm pretty sure that international paper is in that as well. So let's take a look at international paper, symbol is IP. P ratio 23.5 versus not material for the industry. Price of sales 1.1 versus 0.7. Price to book value 5, that's well above the industry at 1.8, and price to cash was expensive as well compared to the industry. For international paper, it's 10.8 versus 6.4. Now you get a pretty good dividend here. It's 3.6%. They use 84% of their earnings to pay that out. Now sales are down 6.7% year over year. Industry is down 20.6. However, earnings per share for international paper, well, they were up 48% when the whole industry was down 292. Now, one thing about international paper, and I've looked at it for years, they've always carried this high amount of debt. The current ratio is 1.5 versus 2.4. That's okay. But the debt to equity is 103 versus 66. So it's not like a terrible, but I wish it was a little bit lower just to make me feel a little bit more comfortable with the company. Return on equity looks very good, 13.3 versus a negative 4.6. Net profit margin checks in at 4 versus negative 2.4. And the receivable turnover for international paper over the last 12 months is 5.5 versus 7.4. But inventory turnover, very good here, and I think very important for a company like international paper, 7.6 versus 4.3. Chase, what about the earnings going forward?
So current price here for international paper, $57.76. 52-week high, well, that's $65.27. And the 52-week low, $33.92. If I go out to December 2022, I see estimated earnings per share of $5.51 would give us a target sell price of $91.47. So I'd like to see that. Also, the growth here looks pretty sound as well. I mean, in 2019, they made $4.43. 2020, of course, with COVID, they really struggled. Fell to $2.80, but this year they're estimating $4.80, kind of back on track to seeing more growth there. And then next year, $5.51. I mean, that's pretty substantial for I'm going to say a pretty basic company.
Yeah, and I like it too because, again, I don't see anything coming up changing cardboard or
corrugated
boxes because you've got that shipping. And I've never even heard anybody talking about anything like that. And we know that shipping is going to be continuing on from Amazon and UPS and all these other.
There's been some talk, like there's the poly bags now. There's been some talks of
which would be plastic.
I don't know exactly what they're made of.
Yeah, see, that's one thing that you want to kind of look at, David. Like what could replace them? And I just don't see anything, and I'm sure there's something out there, but there's going to be some material that maybe it still uses the materials that they're using. Yeah. So. But I like the company. It's a good company. It's what, 57? You said the target sell price is what, 90?
91.
91. Yeah. So I like it. Plus you get that nice, what was it, 3.5% dividend. So I think it's a good one. I like it. All righty.
Oh, okay. Thanks for your analysis. Appreciate it, guys.
Okay, David. Thanks for calling. Have a good one.
Okay. You
Bye-bye.
too. Bye-bye.
All right. That opens the phone line, 866-577-2473. That's 866-577-2473.
I'm glad to see that balance sheet a lot better, because remember a couple years ago we were looking at this and another corrugated box company, and we didn't buy either one, but looking at this one, I can't look at it. That's too high.
Yeah.
And that's reasonable.
And I would like to look deeper into the company, see what else they do. We know also they do paper. They do cardboard, corrugated board, I think you called it. What else do they do? Because it could be a company that is one of these what we call big dumb companies that you're not going to see it double in price over the next year, but you could get over a 5-10 year period, perhaps a nice 10, maybe 15% return just by the company doing the right things. And I would that's a business I love. I don't want to say I would rather get that than a company that doubled, but it's nice to see that. Where I look back 5 years, like I invested $10,000 in that company. Now 5 years later it's worth I don't know, $17,000. You're happy with that. So
I did kind of look this up as well. They do have a segment that provides fluff, market, and specialty pulps that are actually used in absorbent hygiene products such as baby diapers, feminine care, and other non-woven products, tissue and paper products. So there's some other things that their products can be used for. They also do obviously have the printing paper. So
yeah.
It'd be interesting to kind of see a breakdown of where their products are used. And as I said, I think there's some potential there.
And also, too, how much of the printed paper, what is their profits from that? Because that probably is a declining business, but what the other businesses are. So it's very important when you're looking at a business, how much percentage-wise is that coming from? If it's very small and the other is growing more than that, then you're fine. So these are things you have to look at when you're investing in the company. All right, phone number is 866-577-2473. That's 866-577-2473. Let's go back up to Alpine and speak with Adam. Adam, you're on the Smart Invest Show. Brent Chase, how can we help you?
Hey, how's it going? I was hoping you guys might be able to check out one of these companies I'm holding. I've lost a little bit of money since I bought into them, but I still feel like they're really undervalued, so I'm wondering if I might add some more.
Okay. Is that the Louisiana Pacific Corporation?
Yes, sir, LPX.
Is that a railroad? What is it?
No, they are a lumber company, actually.
Lumber company, okay.
I came across them when I noticed lumber prices were going up. In my brain, I said, well, it doesn't cost much more to turn trees into lumber than it did 2 years ago, so less debt to equity, more profit margin. Hey, the stock may go up, so I bought 100 shares. I wheel trade everything that I do. If I like a company, I'll hold it, put my contracts way out of the money, reinvest that money into the next thing that I want to do my wheel trading with. But I'm holding these guys. They've lost about 15%, and I'm bag holding now, just kind of going, well, what do I do here? Do I add more and just wait for that price to go up? Because my sell price I have for them is about $95.
Okay. All right. Well, let's say it's Louisiana Pacific Corporation. Symbol is LPX. Good start here, Adam. I see the PE ratio is 7.7 versus 22.9. Price of sales, though, 1.8. That's above the industry at 1.4. Valuation ratios, you do want them lower than the industry average. Price to book value looking very good, 4.4 versus 71. And price to cash flow also looking good, 6.3 versus 14.8. I do say they pay a 1.3% dividend, about the same as a 10-year Treasury. They only use 8% of their earnings to pay that out. Now sales, year over year, are up 39.2%. That's more than double the industry growth at 15.2. Earnings per share were up by 88,000% versus 439. So that's kind of a laughable number there. Something strange there with those numbers. You got to check those numbers, see why it's so strange like that. Current ratio 3.4 versus 2.1. Debt to equity looking very good, 24.6 versus 86. We do see return on equity is 65 versus 20.6. Net profit margin is 24.3 versus 6.2. And look at the efficiency. We see receivable turnover is 18 versus 8.3, and inventory turnover is 6.7, just slightly above the industry at 6.5. Chase, what about the earnings going forward?
Yeah, so current price here for Louisiana Pacific Corporation, $55.44. 52-week high, well, that's $76.35. And the 52-week low, it's also done well off that, as it's $27.01. Now, if we go out to December 2022, I see estimated earnings per share of $6.33. It would give us a target sell price that's very attractive at $105.08. So it looks good on the valuation side there, Adam, but I want to be very kind of cautious on it because this company, we know what's kind of going on in lumber. It spiked, I think, 400%, then it pulled back 40%. I don't know what's done as of late, but the problem here is that the cyclicality in the earnings, this is just insane. I mean, in 2019, they made 37 cents. In 2020, they made $4.31. This year, the company is estimated to make $12.53. And as I said, next year it's $6.33. So those earnings get pretty much cut in half next year. So I think the analysts are foreseeing this kind of sustained decline from the peaks that we saw in lumber, which is going to hurt those margins. And generally, that's going to kind of bring things down. So I'd be curious kind of more on a more normalized run rate. What would this company earn? Is $6.33 too much? I think a target sell price of $105 is a little too high. And it's hard to predict the lumber movement right now.
Yeah. And that's one thing you want to be very careful, Adam, because it appears to be a value company, but you want to be careful because, again, as Chase pointed out, in 2019, there's nothing going on. Why they only earned 37 cents and now $12.53, next year $6.33, is that sometimes these companies jumping in and out of being appear to be a value company, but I believe this is trading as a commodity company because of lumber. And you can get burned on this because if lumber doesn't come back up, those earnings could fall from $12.53 down to 11 to 10. All of a sudden, the stock never comes back up to 55. So these are ones that we actually looked at another lumber company. We decided not to do it for this reason. The earnings were just way over the board. I mean, all over the board. So we decided not to do it for that reason. So be careful here, okay?
Definitely. Well, I appreciate it, guys.
Well, thank you for calling. You have a good Saturday.
Yeah, I will. Thank you.
Okay. Bye-bye. All right. That does open the phone line, 866-577-2473. That's 866-577-2473. And I just want to announce on Thursday evening, August 26th, 6 o'clock, we'll be holding a smart investing workshop. Going to show you how we invest our clients' money and our own personal money as well. I have been in the finance world for over 40 years, so I have a lot to share with you of different things I've done and learned over those years. We will be discussing the question I hear a lot lately. Do you think there's a correction coming? How important is compounding for investors? We'll also give you our thoughts on the current inflation environment, how that's going to affect investing, and also go over in detail all these numbers you hear on the show. We're going to go over those and show you how we use those when we invest our money and our clients' money. It is a free workshop, but you do need to register. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com, or call the office, 858-546-4306. That's 858-546-4306, and talk to Brianna. And Chase, I'm pretty sure we did update the on the website. We got to double check that, make sure it was updated on that. So
pulling it up right now,
just to make sure, because I was just thinking, gosh,
that's up and running.
All right, so we're good. See, there it is. All right, good. All right, so we hope to see you on August 26th, 6 o'clock for the Smart Investing Workshop. All right, let's go back to the phones here. Let's go up to Carlsbad and speak with Barbara. Barbara, you're on the Smart Investor over Brent Chase. How can we help you?
Hi, I've got a question about the companies that are offering charging stations and access to charging stations for electric cars. You talked about the charging stations where there were cars lined up to be charged.
Yes.
And what happens when there are blackouts, brownouts, flex alerts?
It's a great point. And I do wonder, Tesla's...
Because they say do not charge your car during the flex alert.
Yeah.
I didn't think about that one, Barbara. That is a great point. What do you do?
And what would happen to the stock?
Well, it would just be, because a blackout would just be, or the brownout would just be here in California. So it wouldn't affect the rest of the country. But it could affect it, because I do believe that a lot of electric cars are in California. I think we're probably the leader on that.
We are.
Yeah. But I think it could be a problem temporarily on those companies. But yeah, I never even thought about that. And now I know some people I know they have solar panels so they can still charge their electric car. But if you
Yeah,
don't.
but they say at home don't do it either.
Say that again?
When they say, oh, we have a flex alert between 4 and 9, do not charge your cars at home.
If you have solar electricity or solar panels and plus a battery backup, I don't know if they could tell you not to do that.
Well, they ask you not to.
Yeah. Well, yeah. They ask a lot. Sometimes they ask silly things. We don't have to follow them, do we?
But I was just curious.
No, I'm glad you brought that up because I think a lot of people kind of scratching their heads like, yeah, I never thought about that.
Well, it's a good point, too, because, we talk a lot about how solar works really well here in, San Diego especially. But what about in places that, it snows a lot, rains a lot? Yeah.
Norway, where they don't have sun?
Yeah.
Sometimes?
Yeah.
So the stations, if they weren't allowed to charge cars during alert, they'd lose money.
Yeah, that's true. And, we in our office, my operations person, Eladia, she has, both her and her husband have electric cars. I'm going to ask her on Monday, what do you do when you're told not to charge the car?
Maybe a hybrid is fine, but I was just curious about that.
Yeah. Maybe somebody else is going to call in with an answer to that because I never even thought about that because we do expect them coming up this summer that there's going to be some blackouts. Yeah. And what do you do with an electric car?
I guess you got to plan around it, but sometimes I know, I didn't have electricity in my house for like 2 days last year.
And I'm wondering at the house, but does the charging company, well, I guess they have no power to charge it. So you're just sitting there and
can't do anything.
Just curious.
Yeah. I think when that happens, I'm going to get my gas car and drive down to those charging stations and see what they're doing. Okay. Barbara, thank you for the great question. We appreciate it. And the comment.
Alrighty.
Have a good day.
Bye.
Bye-bye. All right. That is a good question. I've never, ever thought about that because I'm complaining like, gosh, I can't run my air conditioning. It's hot in here and so forth. But at least I can put my car and go somewhere. So
I guess you just got to hope that your car's charged.
That's true. So, all right. Our phone number is 866-577-2473. That's 866-577-2473. Let's go to San Diego and speak with Bobby. Bobby, you're on the Smart Special. Brent Chase. How can we help you out?
Hey, what's up, brother? How you doing?
Good. How you doing?
I wanted some input on Axos. I invested last year when it was kind of lower, around 30s. It kind of does the little snake effect where it jumps up, goes down, jumps up, goes down. It's always if you sell at the right time, there's always a nice little profit, but I just don't know if it's going to be crashing soon or if it's going to be taking off even higher.
Do I have the symbol right or no?
It's AX.
Oh, AX. Okay, that's why. Yeah, because I'm getting some issues here. So let me try AX because I put in the whole thing. So AX like axe. Let's see what we come up with.
Yeah, OS.
Okay. Yeah. Okay. So now I got a internal error here on mine. Let me try something else here.
Oh, this is another regional bank here, huh?
That's what I kind of
thought.
thought.
There's no dividends though, which is the downside to it. But there's always good profits off it.
Okay.
Yeah.
Decent profits.
Profits, yeah. And you said you hold it or you're looking to buy it?
I'm holding some right now. I'm tempted to buy more. Okay. I just don't know the direction it's going in. It just spiked. I sold a little bit. Now it's dropping, and I don't know if I should buy more or just hold off.
Okay, well, let's say it's Axis Financial Incorporated. Symbol is AX as in axe. We do see a PE ratio of 13.2, just slightly ahead of the industry at 11.7. Price to sales 4.4 compared to 2.9. Price to book value 2.2 versus 1.55. And price to cash was 11.8 versus not material. So the valuation ratios look, I'm going to say a little bit expensive for me. We do see they do not pay a dividend. I'm surprised for a financial company not paying a dividend. We do see sales year over year were down 0.8% when the industry was up 0.09. Earnings per share declined by 21.4, better than the industry at 14.9. Look at the balance sheet, current ratio, not material because it's a bank company. We do see the debt to equity very good, 67.8 versus 313. Return on equity for Axis Financial is 16.4 versus 10.7. Net profit margin, well, that checks in very good at 33.5 versus 24.7. Chase, what about the earnings going forward?
Yeah, so current price here for Axis Financial, $48.56. 52-week high is $54.36. The 52-week low, well, that's $21.27. If I look out to June 2023, I see estimated earnings per share of $3.99. Would give you a target sell price of $66.23. So, I mean, the value is definitely here, Bobby. It's a great value business. I am curious if it's a younger bank. I mean, it was founded, I think, in 1999, so a lot younger than the early ones we talked about in 1828.
It's one of the newcomers for sure.
Yeah, so curious kind of how they're growing.
Something to prove, though.
Yeah, exactly. But they are in Las Vegas, Nevada, too, and we know that Vegas's economy is we believe, going to be coming back and coming back very, very strongly as we come out of this pandemic. So that could be an interesting way to play the Vegas economy, having that regional bank there. And again, great values.
Yep. So, yeah.
And if you look at their history, like I said, they drop, but they always come right back up, and they come back stronger, too. Not by much, but enough to be happy with.
Yeah, and it could be buying opportunities, but again, check the bank, make sure everything looks good on it, make sure there's no problems, because you'd hate to say, well, it always happens until it doesn't, and then you lose money on it. So, I think it's definitely worth the research on it. I mean, I kind of like it. Also be in Vegas. Did you see how many branches they had, Chase?
It didn't give me that.
Yeah, yeah. So, because the other thing, too, you want to be careful of is just to make sure that it's not too focused just on Vegas, because that could cause problem if we do have, I don't think it's going to happen, but a major lockdown again and Vegas closes down, that could be a problem for the bank. So just be careful there.
Yeah.
All right, Bobby?
Okay. I appreciate it, guys. Thank you.
All right, man. Thanks for calling. Have a good one. Bye-bye.
You too.
All right, that opens the phone line, 866-577-2473. That's 866-577-2473. Let's go to Escondido and speak with David. David, you're on the Smart Invest Show, Brent Chase. How can we help you?
Hey, guys. How you doing today?
Good. How you doing?
Good. So I've got kind of an interesting question. So I have a little side hustle on eBay, and I'm bringing in about $300 net a month. For not a whole lot of work. And I don't do a lot of stocks. Mainly the money just gets dumped in the bank, which isn't earning me anything. I'm considering maybe doing a little investing into stocks that have more of like dividend potential. We'll just like say AT&T, for example, and then just sit on them for long term. Is this like a good play, or do you guys have a different suggestion?
I mean, it could be, because I think you said $300 a month. It's kind of hard to start getting into companies like that. We really don't recommend to start investing into individual equities till you have at least $5,000 and kind of diversify a little bit, because you'd hate to start doing it and the one that you invested in went down 50%. You'll never come back again. So what you may want to do is maybe look at a good value mutual fund and start putting the money in there. And then when you reach, $5,000, $6,000, $7,000, then start looking at, some individual companies. So then you get, 6, 7, 8, 10 different companies, and you kind of listen to the show. How long have you been listening to the show there, David?
What was that one time?
How long have you been listening to the show?
Very, very new listener. Very new.
Okay. Well, what you can do is keep listening to the show, kind of write things down. I like the idea of kind of building the portfolio, and it may take you a while to get started, but I'd rather have you get started in the right mode than, again, buy one or two stocks that are very poor. You lose money on it. You don't do it anymore. So start off slowly. All ready?
Okay. Cool. Thank you, guys. Have a good day.
You too, David. Thanks for calling. Bye-bye.
I was going to say, too, I think it is. I don't think it's a bad idea to save money and invest that money. I think that's an awesome idea for David to, put money, the excess cash flow, invest it. Because if you don't need it, don't just put it in the bank and have it sit there, unless you don't have some liquid savings, of course.
And I don't know his financial situation, but if he's not doing like an IRA or something, and take that $300 a month, put in an IRA, get the tax deduction for it, then you have even more money left over. So maybe you can invest instead of $300, maybe invest $400 because you get a tax deduction for it. So you'll grow your money much quicker. And I say much quicker, I'm talking 5, 10, 15 years down the road. You do that, wow, I've got quite a bit of money now by doing that. So, but that's why I was saying to go slow when you're doing that, because I'd hate to see you do it $200 or $300 a month for 6 months, and you bought some crazy company that went down dramatically, and you lost 30%. You might just say, I'm not going to do this any longer. So, Alrighty, phone number is 866 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Brandon. Brandon, you're on the Smart Invest Show. Brent Chase, how can we help you?
Hey guys, great show. Wanted to call about Cleveland Cliffs. I called you guys probably about 3 months ago or something like that. I didn't take your advice and kind of still invested, but now it's gone up, and I wanted to see what you guys thought about it now.
Okay, so I take it that 3 months ago we thought it looked pretty good. Is that what you were saying?
No, we said don't buy it.
No,
we said don't buy it.
You guys thought it had a little too much debt.
Okay.
But my research, I thought they could pay it off, and then they did pay it off. And then now we have the infrastructure bill kind of going through Congress, and so I kind of wanted to see what you guys thought about it.
Okay, well let's take a look at it here again. Coming again is Cleveland Cliffs Incorporated, symbol CLF. We do have a good start in the PE ratio, 16.4 versus 26. Price of sales also is good, 1 versus 3.6. Price to book value, 4.6 versus 5.6. And price to cash flow, 8. That is below the industry at 13.4, and that's a positive for valuation ratio. They do not pay dividends. We do see sales are up 411% year over year, above the industry at 14.5, and earnings per share for Cleveland Cliff, well, they're up 1,914 versus 131 for the industry. Now, the balance sheet, you got a current ratio of 2.2 versus 2.5. That is good. The debt to equity now, and let me see, and this is as of June, is now 135.1 versus 85. I don't remember what it was before, but now 135. Still a little bit concerning on it, but if everything else looked pretty good, we could say, yeah, we might want to invest in this company. Return on equity is 43.4 versus 2.4. Net profit margin 7.1 versus 6.1. And receivable turnover 10.2 versus 7.2. Inventory turnover 3.6 versus 3.3. Chase, real curious on the earnings going forward here for Cleveland Cliffs.
So current price here for Cleveland Cliffs, $25. 52-week high was $25.83, and the low, $5.16. If I go to December 2022, I see estimated earnings per share here of $3.22. It would give us a target sell price of $53.45. So, I mean, we know the valuations are very strong on this one, Brandon. And the thing is, as you said, it looks like they paid off that debt, which is nice because it reduced their debt to equity. Kind of similar, I think, to the lumber company. That these companies do scare me a little bit because, again, the extreme cyclicality. They're commodity-based companies, so if those commodities turn south, it doesn't matter how well run the business is, that stock price is going to head south as well. So, I mean, I'm glad you've done well on it. Just be careful with it as well.
And actually, one thing, too, you want to think about here as well is that with this whole infrastructure bill, there's a lot of confusion on it. It's not like, all bridges and roads and steel and so forth. It's like there are other things they're trying to put in there. So that's what kind of worries me, too, like how much of this will really benefit a company like this, and maybe it doesn't go through yet. What's that?
No, I agree. I was wondering just because I know, sometimes when the government starts spending more money on that stuff, then it holds the price to hopefully get to that $50 mark. That's what I think my exit strategy is going to be. But thanks, guys.
Yeah, and I think now with the lower debt, more reasonable, that it does make sense to look at this company and maybe perhaps put it in the portfolio.
Yeah.
All righty?
Okay, great. Thanks, guys. You have a good evening.
You too, Brendan.
Good morning.
Thanks for calling.
All right.
Bye. All right, that does open another phone line, 866-577-2473. That's 866-577-2473. Let's head down to Chula Vista and speak with Buckley. Buckley, you're on the Smart Investor, Brent Chase. How can we help you?
Hi. So my wife and I have a rental property that we're going to be selling here pretty soon.
Okay.
But we do not want to buy another property, but we also don't want to, I mean, if it's possible to not get hit with the capital gains tax, I don't know if that's possible since we're not going to buy another property, but how can we invest the money from the sale of the property so that we don't get hit with taxes so hard?
Unfortunately, and how long have you held the property there, Buckley?
Probably 8-9 years.
Okay, so I mean, you've probably done extremely well on it. Unfortunately, part of investing, sometimes you do have to. Uncle Sam wants his little piece of the pie there from you, unfortunately. But what you have to look at is like, okay, what was my net return after I pay the taxes? Probably you still did pretty good. And then what you have to do is like, okay, so what do we need now going forward? How can we invest this money? Were you taking income from the rents? What were you doing with the rent money?
Yeah.
Okay, so you need something else maybe that's going to pay you income as well?
No, we don't.
You don't. Okay, so you just want to invest the money and have it work well for you. I mean, it depends on your. Go ahead.
We would like to invest the money so that our children can use it for their college education down the road.
Okay. So that'd be something else you do is kind of let it grow, and then as your children need it. Because one thing that people kind of forget about when your children go in school, they don't need all the tuition. September their first year. It is over another usually like a 4-year period. So you kind of take distributions from that point in time. So what I'd recommend is kind of sit down once you sell the property. Sit down, and again, if you want to call our office, I'll give you the phone number. We can sit down with you, kind of go over how to do that, what you need, and so forth. How to invest the money to make your goals that you want to get, because but you do have to pay the taxes. And if you want the phone number, I'll give you a phone number, so you can give us a call on Monday if you want.
Okay, great. Thank you very much.
Okay, bye bye. Oh, did you want the phone number? I'm sorry, did I mess up?
I don't have anything to write with right now, but you can go
to our website too if you want. You can contact us there. It's smartinvesting2000.com. Again, smartinvesting2000.com. You can send us a message if you want any kind of assistance, because it is kind of baked into what you're looking at, what you want to use the money for. So go there, and hopefully those have helped.
Yep.
I very much appreciate that.
Okay, Buckley, thanks for calling. Bye-bye.
Yep.
It is so hard. I think a lot of times people try and avoid the tax. I mean, I've seen people when they sell properties, they try and do something else that's a lot of times there's ways to avoid the taxes. And I did little air quotes here. People can't see since we're on radio. And then you put it in something that's many times non-liquid. And then you end up costing yourself money, because if you would have just paid the taxes, you'd be better off in the long term. So that's what we were kind of talking about earlier in the show is, sometimes you just got to pay the taxes, and that's the best thing you can do.
Yeah. And again, then you look at the net return. You probably still did very well. I mean, you bought the property 8-9 years ago. You probably did very well. Your after-tax return might be, I'm just throwing out a number here, maybe 7, 8, 9, 10%. Who knows what it would be, but it's still very good after tax, because you compare that to tax-free. Tax-free was probably about 2 to 3% back then.
Yeah.
So you still did very, very well. So you have to kind of look at that. All right, let's go up to Escondido and speak with Tim. Tim, you're on the Smart Special Brent Chase. How can we help you?
Hi, guys. Thanks for taking my call. I had a real quick question as it relates to dividends, and if there's a particular website or somewhere where you can see if the dividends that are paid by a company are either qualified or taxed at ordinary income.
I don't know of a website. Do you, Chase?
I do not. I'm guessing if you go to that company's website and the investor relations page, you could probably see that there. I mean, they're going to have to tell you if it is qualified or not qualified. And I know many times, like REITs, they're taxed differently, so you got to be careful of that in terms of taxation. A lot of your bigger companies do pay those qualified dividends. So, long story short, Tim, it's a great question if there's a website that just lists out if it is qualified or unqualified. But I think the best place to do if you have a particular company in mind is the company's investor relations page.
And I believe there's a general rule that if they are borrowing the money to pay out that dividend, it's not qualified. I believe the dividend has to come from actual earned earnings. So they do the qualification on that. But that's just kind of like a rule of thumb. Do you have in a lot of different stocks there, Tim?
Well, no, I honestly, I've been listening to your show all day, and the discussion about dividends is so germane, especially since interest rates, if you're holding cash and you're waiting for that correction and it's not coming, it's almost better to go into some type of dividend play. But if they're taxed at ordinary income versus, qualified, capital gains, it's a big difference. Or qualified dividends. So, and especially when you factor in, what you're earning and things like that, you have to play it out and really be conscious. And so that question just came up, and I was just wondering, as a general rule, if a company's listed on the New York Stock Exchange or NASDAQ, do those companies issue qualified dividends as a general rule, or it really just depends?
Yeah, it really just depends. It's not a general rule. And again, I think it comes back to where those earnings came from, how they're paying that dividend. and that's how I think they do it. But most of the time, you're going to have your companies that they all pay qualified dividends, unless you get into the really strange ones. And again, Chase brought up a good point. They're not strange, but REITs are not qualified.
Yeah, I got a couple other ones here too. It looks like MLPs are another one you got to be careful.
Yeah.
And those create a whole different chaotic situation.
Terrible tax
situations. Also, too, like dividends paid on employee stock option plans, with dividends paid by tax-exempt companies.
Yep.
Those are all going to be non-qualified or not qualified dividends there. So,
Right.
but a lot of your big companies that you look at buying on the New York Stock Exchange, those are going to be qualified for the most part.
Yeah. So.
Right. And I know by rule, REITs have to pay out 90% of their earnings, so they are ordinary and not qualified. Got you.
Yeah.
Okay.
Yeah. So, but I think if you buy
All
your
right, guys.
normal companies that are generally listed, you'll probably do fine there. All ready?
Yeah. Okay. Thanks for the call, guys. Thank you. I appreciate it.
Okay, Tim. Thanks for calling. Have a good one. Bye-bye. What's else? We got just a few minutes left here, so I did want to kind of talk about the workshop because it is coming up on August 26th. And at the workshop, we talk for probably like an hour and a half. We go over a lot of different things that we talk about here to really help people understand more what we're doing. We show everything we do. We talk about things they should not be doing as well. Also, too, it's a question and answer. We do at the end allow people to ask questions and stuff and kind of really help you understand more about investing. And we show you everything we do. People say, well, gosh, you don't keep your secret sauce to yourself? Like, no, we show you what we actually do.
It's going to take work.
And that's the thing. It takes time to do. I mean, because we do listen to the conference calls. We read the conference calls. We go over all the information. So we show you everything we do and how we do the numbers every Monday. We go over all these numbers and so forth. The key is we show you what we do, and we do it for people. That's the big thing is most people say, well, that takes too much time. I can't do it. Well, we show you what we do, and you can hire us. And that's why a lot of people come to the workshop, too, to say, well, maybe I want to hire these guys, Brent and Chase. I hear them every Saturday. They have a lot of common sense. Maybe I want to do that. But come to the workshop for that as well. It is free. We'll go over all the information for you. But what you got to do is sign up. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. You can call the office at 858-546-4306. That's 858-546-4306. Talk to Brianna. She got you signed up. But looking forward to seeing you on August 26th, 6 o'clock. For the Smart Investing Workshop. So
it's going to be a good one. Yeah.
I mean, it's always great to meet new people and talk to different people. And people say, like, wow, this is really different. It's not a sales seminar. It's not a sales seminar. We actually educate you on what we do.
Yeah. So, yeah. I was going to say, interesting show today. A lot of regional banks that we went over, a lot of tax questions as well. So, the other thing we tell people, too, is if you just turn in now and you missed a large portion of the show, you can go back on our website and always listen to our podcast. Again, that's smartinvesting2000.com. You can listen to the podcast there, or you can also go on Apple, Spotify, TuneIn, those major players, and listen at your time. So if you kind of looking for different companies, building your portfolio, it could be a great help to you.
Yeah. And actually, while they're at the website, they can also sign up for the website for the workshop and see other information there as well. So when do we get it onto the website? Do you know?
What?
The podcast.
Normally it's after the show.
After the show?
Yeah.
Okay. Yeah, so we try to get up there right away. I do want to apologize for John and Marietta. Sorry we can get to you. Please call in next week. We'll get to you. But here I want to talk about RGA or Reinsurance Group, another good topic I would have loved to talk about, but I didn't want to cut them short and not be able to talk to them. So, and there again, there is a closing bell. So thank you for listening to the Smart Investing Show. It is for information purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306, or visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information, along with investment tips, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Today's show is sponsored in part by Thomson Reuters. Closing song, Frank Sinatra's My Way, is performed by local entertainer Roman Palacios. He will be at Kona Kai Resort on Shelter Island, Sinatra's Era, Sunday at 5 o'clock. I hope to see you there. We will be there. Have a great day. Talk with you soon.